Hi everyone. I hope you can hear me. I think we are live now. Apologies for starting late. We are facing some technical difficulties due to which we couldn't start on time. Okay, I welcome you all to the February AMA webinar for Gulaq. Here's the agenda for today. I'll quickly talk about our firm Estee and Gulaq because there are quite a few new investors also who have joined this for the first time. Then I'll take you through the rebalance update for February. And then we'll talk about the returns, and we've got quite a few questions from your side, so we'll address those as well. Yeah. So Estee is a pioneer of systematic investing in India. We have been doing quant investing since 2008. We currently operate in about 6 countries. We have also been awarded Institutional Member of the Year, and we are currently managing assets of over 1,500 crores. This is spread across India, Brazil, US, and few other countries. We have also been running our very successful PMS since 2009 iAlpha and also Long Alpha since last 6 years. Right? So Gulaq is a brand which was started within Estee. It's the retail investment advisory arm of Estee. And again, it uses the same sophisticated quant algorithms that are developed by Estee to serve not only the institutional clients but also to retail investors. This Gulaq services was launched in 2020. We are a SEBI registered investment as an advisor. We have served over 25,000 subscribers till date. And our methodology is a multi-factor algo-based investment methodology. Uh, about our founder, Sandeep Tyagi, he founded Estee in 2008. He's a BTech from IIT Delhi and MBA from Columbia. And he has over 30 years of experience in portfolio management, analytics, and consulting. I am the investments head at Gulaq Estee. I've done my BTech and MTech from IIT Kharagpur, and I have now close to 20 years of experience in trading and investment management, both in India and abroad. These are the disclaimers. Please go through them. Yeah. So in December, we launched new market cap portfolios. Also, quite a few investors actually wanted more flexibility and more control over how they want to invest their money. And we got huge requests about launching these market cap based portfolios. So these portfolios were launched in December. So it's been just 2 months, but I can share what is to be expected over long term because we have done quite a bit of back testing and developed. These the models are similar, quite similar to what we have been doing in Gulaq Gear 6, which is a multi-factor approach. However, there are small, minute changes between these. Otherwise, broadly, the methodology remains the same. The large cap portfolio, again, large caps constitute the from the top 500. We select only the top 100, which constitute the large cap universe. And if you see, it's been 1 month, but the back tested results again have delivered decent alpha. Again, this is back tested, and obviously returns in the live market. This does not guarantee anything, but it does give you some sort of indication what can be expected. In mid cap, again, over long term, we have had decent alpha in the backtest results. Now, all of these results, they've been backtested for about 12 years of data. And secondly, these results include the transaction cost, slippages, and DP charges at 1 lakh capital. Right. So we have assumed some sort of cost. These costs, 12 bips, is assumed on the basis of if you are with a discount broker, then more or less this will be the cost will be same. However, if you are with full service broker, these costs obviously would be higher depending on how much brokerage you are paying. For small cap, if you look at 1 year, 3 year, 5 year, or 10 year CAGR, again, I think small cap has delivered the most alpha in our backtest results. Obviously, it's been just 1 month we have been live, so we have very limited live track record in Gulaq market cap based portfolios. But we have got pretty good response, and lot many investors have also now subscribed to this. Now, just a word here. Now, these are meant primarily for investors who understands market well and who have some view on the specific market cap based universe. So if you have a specific view, if you understand, then you can express your view through these market cap based portfolios. But having said that, if you really do not have any view, you are not missing out on anything, because in Gulaq Gear 6, it's exactly meant for the kind of investors who want to approach investing by being passive and not taking these kind of calls. So investors who have just invested in Gulaq Gear 6, they are completely fine, and it's not really required to take these kind of calls. It's just that if you have a view and understanding, then you can take. Now, talking about these Gulaq Gear based portfolios, we have these 4 portfolios: Gear 3, 4, 5, 6. And the difference is in the asset allocation. As you can see, Gulaq Gear 6 has 100% equity. Gulaq Gear 5, 20% debt added, and equity becomes 80%. Gulaq Gear 4 is 60% equity, 40% debt, and Gear 3 is 40% equity, 60% debt. So if you want to take lower risk, if you really don't want to be as aggressive and you want to take lower risk in your investment, then you should definitely consider Gulaq Gear 5 or 4 or even 3. Now, over long run, I can tell you, like, Gulaq Gear 4 has also beaten the 100% equity benchmark. You can go on st.smallcase.com to check the live track record of these portfolios. They have done fairly well, delivered fair amount of alpha over the past few years in live markets. Right, so we have a decent track record of all of these portfolios. Now, if you talk about the rebalance update, this is specifically for Gulaq Gear 6. The changes from Jan to Feb are fairly minimal. We have increased our allocation to 30% in small cap and slightly decreased our allocation to large and mid cap units. This is the sector. Again, in sector, no major change from January. If you see, pretty much we are in line with what we were doing in January. Some smaller changes over the sectors. But if you consider the factors, now factor has definitely changed. Till January, we were focused primarily on leverage and quality. And in February, this has been now transitioned to value and momentum. Now, this can definitely happen that there could be a fair bit of churn in the factors. As you can see, these factors have totally changed over last month. But if you see our portfolios in terms of sectors, there's not a big change, and we have, and this is definitely the point I'm trying to make, is this is definitely possible that a few of the sectors or even stocks have a higher weightage in most of these portfolios. So earlier, similar stocks were getting selected using quality as a factor, but if they have a higher weight on the basis of momentum and value, they would get selected using these newer factors as well. Now, this is the Gulaq Gear 6 performance. Obviously, you can see we have had a tough last year where we have delivered a negative alpha of about 12% in last 1 year. But even if you consider this last 1 year and you take the longer term results, we're still doing very well, delivered close to 20% alpha since going live. So again, as we've been saying time and again, short-term performances definitely can deviate from longer-term expectations, but our longer-term expectations still remain pretty solid, and we expect a decent alpha over the next few months and even years. Right? I think looking at the back-tested results also, that gives you some sense of what is to be expected. So over any 1 month period, we have a success rate of, I think it will be somewhere around 55 to 60%. If you increase your holding period to 1 year, that success rate becomes closer to 90%. And if you increase your holding period to 2 years, the success rate is, I think, 100%. So that's the way equity markets also work. The longer you hold, the more probability you have of success and of positive returns in the longer run. Obviously, in the short run, markets are much more volatile, and the results can also be volatile. Now, Gear 5 performance, obviously, the trend has been similar. If you see the changes between Gear 5 and Gear 6, the equity component remains exactly the same. It's only that in Gear 5, you have 80% equity and 20% debt is added to reduce the volatility. The lesser volatility in this also leads to slightly lower expected returns. But these are meant for investors who don't really want to take a very aggressive stance in their portfolios. Gear 4 also, if you see, the trend has been similar, and same is the case with Gear 3. Even in Gear 3, we have delivered. Gear 3 is 40% equity, and with even 40% equity, if you see, over since going live, we have been able to deliver decent alpha. Considering that this is not a fair comparison also, because the benchmark here, what we have taken is a multi-cap benchmark, because on small case, that's how you can compare. You can only compare your performance to equity based indices, right? So even though this is not a fair comparison, we just have 40% allocation to equity in Gear 3. Still, we have been able to beat the benchmark by a decent margin. So overall, this has been the performance over last few years across different time frames. Okay, and this is the year-wise performance. If you see this specific year, last year, calendar year, we were close to zero alpha. This year we started with slightly negative alpha in January. But again, the point here being equity markets, that's the nature that of active investing, that there are few periods, definitely there'll be few periods where any active fund would underperform its benchmark. It's very, very hard, I think very rare that a fund is able to beat the benchmark year after year. So this definitely happens. I think it's part and parcel of active investing. Okay, so this is what I wanted to share, and now I'll be taking. We got quite a few questions from your side. People have written to us. So first, I'll be taking those questions, and I see a lot of questions are there on YouTube as well. So I'll definitely take all of these questions one by one. So let me start with the questions that we got in our through Google Forms. What is the maximum drawdown of Gulaq Gear 6 and Gear 5? So this has been asked by Amar. So if you see the maximum drawdown of Nifty multi-cap index, it is 18%. And the data we have taken from May 11, 2020, the date when we went live with our portfolios. Since then, Nifty multi-cap has seen 18% drawdown, whereas in Gear 6, we have seen 22% drawdown, and Gear 5, it is 18%. So our risk in terms of maximum drawdown is slightly higher, you can say, because obviously it is a concentrated portfolio of about 15 stocks. So this would be higher, but it's not too high also. If you see the annualized risk in terms of standard deviation, again, 15% in multi-cap versus 21% in Gear 6. And Gear 5, it's roughly the same risk you have that you have in multi-cap. If you see the annualized returns since our inception, 23% in multi-cap versus 40% in Gear 6 and 30% in Gear 5. So if you consider Gear 5 also, you have a decent alpha with similar kind of risk return profile. And in Gear 6, we are taking slightly higher risk in order to produce this alpha. Okay. This is the drawdown chart. As you can see, the maximum drawdown is, we're currently going through that maximum drawdown. We just recovered some, but this is the maximum drawdown we have seen, and broadly we have been in line with the Nifty multi-cap drawdowns. One thing I definitely like to show here, that if you consider blue line versus the orange line, or even the gray line, blue and gray are able to recover their losses much more faster. So Feb March 22, where we had decent drawdowns of 15%. So multi-cap also had a drawdown of close to 14%, and we had of maybe 16 to 17%. But if you see, we were very quick to recover our losses. And whereas if you see the orange line, it only went to zero till November, right? So what this tells is in 22, the multi-cap took much more longer. And that's been the case most of the time, that it takes longer for index to recover. At least looking at this data, it takes longer for index to recover than it takes gear 6, right? Now, this is a similar thing what we observed in May 2020. Obviously, we are closer to the lows only. We have hardly seen any correction to the upside now. So it's still, since last 4 or 5 months, markets have been in drawdowns only, and our portfolio is also in drawdown. And let's see if we are able to uh, recover faster as what we have seen in the last few times as well. Yeah. Saurav is asking, you advise against attempting to time the market, yet there is a monthly rebalance. How does this not qualify as market timing? So, Saurabh, there's slight difference between market timing and what we are doing. We are rebalancing our portfolios uh, just like any other mutual fund does, right? They obviously do rebalance their portfolios on a monthly basis. Obviously, the kind of churn that they see is much smaller, but they do rebalance their portfolios on a monthly basis, quarterly basis. You can get to know exactly what is the changes. So they are also making changes depending on the changing market conditions, depending on the new information that they get of their portfolio holdings. And that is exactly what we are doing. So this is not market timing. This is just rebalancing our portfolio. Market timing is slightly different in the sense that you take a call on the market, whether overall market is likely to go up or down. So there are a few fund managers in the small case category also, and in the mutual fund categories also, who take a call on the market. So what they'll do is, if they feel that the market is about to go down, they'll shift a part of portfolio from equity to cash or to debt. And when they see that the recovery is now happening, then they'll again move back to equity. That is their way of reducing risk. But in theory, it sounds very good. And our stand is, it's not very good. It's a very hard thing to do actually, because you have to make two decisions, and both of these decisions have to be correct in order for you to come out ahead. So the first decision is, when you move from equity to debt, you have to be right in that decision. And second decision is also, you have to be right when you are moving back from from debt to equity. So those two decisions, even if you get one decision right, but the second decision is wrong, still you will be behind, right? So that is not, in our view, the best way to reduce your risk. What we do to reduce risk is, uh, and this is inbuilt into our algorithms, that a safer factors get selected, due to which safer stocks get selected. And that is how we reduce risk in our portfolios. Again, this is purely a systematic approach that we are using. So this is not exactly market timing, but yes, we do monthly rebalance. Right? Hello, Vivek. I was a bit surprised to see the addition of a few new stocks in the February rebalance. Could you please confirm the factors? So, Amar, I've already shared the factors, and you're speaking specifically about IGL. I think IGL exactly got selected because it ranked high on value factor. But currently, what we are using is value and momentum as the two main factors to select our stocks. What is the rationale behind investing in Mazagon Dock, RVNL, IRFC despite their elevated PE ratios? Okay, lack of additional capital expenditure into defense. So, Anshuman, I think you're a bit mistaken because we do not have these stocks. I have the data. So these three stocks, if you consider since November, we do not have any allocation to this. RVNL, we had some 2% allocation, but otherwise we do not have any allocation to these stocks as of now. Given these factors, these stocks could decline by 20%. See, you're right. But as of now, since November, we do not have any allocation. We just had a small allocation in January, but otherwise we do not have allocation to these stocks at the moment. When they were rising, obviously we had decent allocation. We made decent money in these, and because it's a monthly rebalance, we were able to get out also in time from these stocks. Mani Teja is asking, Gulaq Gear 6 follows an aggressive rebalancing strategy. Given that there are monthly charges such as brokerage, DP charges, STT, and other transaction costs, will these expenses significantly eat into the profits? Additionally, with both subscription charges and frequent buy-sell costs, how does this impact overall returns? So, Mani, what we have done is, obviously, whatever we are doing is based on the historical data, and it's a purely rule-based approach. So, if you see our back-tested performance here of Gear 6, this is the back-tested performance. So, if we take the longer-term performance, what is to be expected is about 24%, 25% alpha over BSC 500. That's what we have seen in backtest. Now, these backtests, we definitely do take into account these costs like brokerage, STT, and transaction cost, which comes out to be about 12 bips on turnover. And we also do take into account the DP charges, which is around 15 rupees per script sold. Now, this 15 rupees, if you have a bigger portfolio of say 5 lakh, 10 lakh, this really wouldn't amount to much. But we have considered this on a 1 lakh portfolio. So this could be in terms of percentage, it's not insignificant. So we have taken into account these costs, and after these costs only, we have delivered this. The backtest shows that there is significant alpha over and above this. Now, there definitely might be few more slippages, or if you're using a full service broker, then I think definitely these costs could be very high, right? So for this kind of strategy, if you are into quant strategy, I believe you definitely everyone should be doing is you should shift to a discount broker, and only then it will make sense. Otherwise, a good part of alpha would go away in the transaction cost. But the point being that from our side, whatever changes we make, we definitely do take into account. Also, we have made some changes in our algorithm after September. So prior to September, our monthly churn was also 94%, and after that, our churn has also reduced, and this reduction is significant. So if you see in February, we had 30% churn, which we haven't seen this kind of a churn in last 1 year at least. So now the expected churn has also gone down. But having said that, I think all those who are on full service broker, you should definitely consider moving to discount brokers. Is there a possibility that we apply no rebalance strategy for a particular month to avoid booking losses and allow stocks to recover or perform better? Is it mandatory to rebalance the portfolio every month? So Bhargav, yes, the answer to this question is yes. It is mandatory because that's what data tells us, that you are able to produce this kind of performance only when you rebalance. Now, I can definitely understand what you are saying. You do not want to book these losses that has happened in few stocks. And I think this is quite common also, Bhargav. So you might have seen, at least I have, talking to friends, this is a very common occurrence that they have purchased a stock which is now in loss and they don't really want to sell it. something which is known as loss aversion, that they don't want to book their loss because that booking of loss really causes them a lot of emotional pain, right? So what they normally do is, and you would know this would have happened. It certainly did happen with me earlier when I used to do discretionary investing. So we keep on holding it till the time it recovers back to that specific price when we bought it. And when we sell it at that point of time, we feel very good that I avoided the loss. But if you consider you avoided the loss, but you held that stock for a couple of years also, right? So let's say if you held that stock for 2 years and you avoided that loss, then there is no point because during those 2 years, there were other opportunities which you were ignoring, right? And the same thing is happening even in this case, in this question also, that you want to avoid booking losses. But the way rebalancing works is every time we try to figure out what's the best stock to be invested in at this point of time. This could be the stock that we have had loss, or it could be a totally new stock. So just making this whole process and this decision making very, very objective, it really helps us avoid these kind of biases that every one of us go through. Right? Certainly, I've had these kind of many investments where I did not want to book loss, but just because I did not want to book a loss, I kept on holding that stock for much longer, and I ignored the other better opportunities that were present in the market. Yashasvi is asked if the same model is used to select and rebalance stocks for Gulaq Gear 6 and small caps. Why are the selected stocks different? Additionally, if both follow the same strategy, why is Gulaq Gear 6 buying Kims whereas small cap is selling? So Yashasvi, the broader methodology is exactly same, which is the multi-factor approach. Now, having said that, there's some finer differences between these two approaches because what we have observed in our backtesting is that these factors, certain factors actually work much better for small caps. So there's a slightly separate list of factors that we use in these market cap based portfolios, but broader methodology of a factor based uh, stock selection and also churning in these sectors, selecting these factors every month. That broader methodology is exactly same, but there's definitely smaller changes between the factors that we select in our multi-cap Gear 6 model versus the small cap. So there could be some smaller these kind of instances only, but overall broader methodology remains the same. And that's why you are seeing there is a small difference and it could happen from time to time. Okay. Okay, should I consider, Pallav is asking, should I consider booking profits in Lloyd Steel? Also, what are your thoughts on banking sector? So Pallav, if you want an honest answer, what I always say is, frankly, I do not know because we have developed this methodology because we don't want to take the calls ourselves, right? We are not very good at making these calls ourselves, and that is why we have expertise in data driven decision making. So we collect all of this data, all the factors that are impacting the stocks and that are impacting the sectors, and then we use that to make our decision making. So like this time when we rebalance, I had very little idea about what could change in our portfolios, right? And that is why we do not, you would never see us taking a call on a specific stock or a specific sector. I would definitely have some views on it, but I do not use it in the decision making while constructing these portfolios. Okay. How should SIP be managed in Gulaq Gear 6 given its monthly rebalancing? Will SIP provide substantial benefits? Rajiv. So Rajiv, I have some data to share, but before that, I'd like to take this question from Poonam, who is asking, do you suggest having cash positions as a part of the portfolio? So Poonam, we do not suggest in having cash positions. I've already explained it, why we do not take cash positions because we don't believe in timing the markets. But having said that, what we also believe in is the asset allocation. So if your risk appetite is not as much and you are not a very aggressive investor, you are not very comfortable with the ups and downs of equity markets, which we are seeing now, then you should definitely consider moving to other portfolios like Gear 5 or Gear 4, in which, or overall also in your portfolio, have debt as a part of your portfolio. It's very important. Now, how much to have? Maybe one thing that you can do is go to gulaq.com. There's a risk profiling survey. It's a small 2-3 minute survey which will give you a decent indication about how much of equity and how much of debt you can have in your portfolio. So that is something that you should do, but having cash really, I don't think that makes sense. Now, coming back to SIPs, Raji, SIP is definitely, I think, very good way of going about investing. Most of the investors that are associated with us are uh, are working employees somewhere, and they get their monthly salaries. And when you're getting monthly salaries, it's always good to put a part of it in investing through SIPs, and not to time the market. And one of the instances is what I have shown here. During 2008 global financial crisis, world over markets fell about 50% or so. And if you see, Nifty also fell about 55%. So this is in January 2008, Nifty was above 6,000, and by January 2009, in 1 year, it it came down below 3,000. So during this time of 12 months, it had losses of more than 50%, and it took more than 2 years to recover also. So it made a new high. It took 37 months. So more than 3 years it took to recover and make a new high from these losses. Now, there are few learnings from it, and one of the learning is many of the investors who are associated with us have started investing in last 4-5 years, and we have just seen one fall. The extent of the fall was definitely closer to this fall only, where we saw markets fell closer to 50% in the COVID, but it recovered very sharply in no time. So in less than a year, it was higher than where it was. Uh, so investors really didn't have to go through an elongated period of pain, uh, which they had to go through in 2008. And this is more normal. This time it was very quick, and that happens very rarely. The kind of fall that we saw, 40-50%, that is once in a decade kind of crisis. But the recovery also takes much longer than what we saw in COVID, right? Like in this case, it took over 3 years. Now, had somebody been doing SIP all throughout this while, had he all started at 6,000 in Jan 2008 and kept on doing SIP during these 37 months, where markets, Nifty produced zero returns, right? His SIP returns, the XIRR is how we use SIP returns, would have been 23%, which is fairly very good. And why this would have been 23%? Because you did not stop investing at just 6,000. You kept on investing all throughout, and you also invested a decent money during these 4-5 months where it was below 3,000, right? And then recovered back. So that's the beauty of SIP. And the reverse also could happen, and also happens, where you have been investing all throughout the bull period, and when it comes down, then you see some of the losses also. But that's the beauty of SIP here, that even in a very flat market, elongated market, you kept on doing your SIP, you did not stop, and your overall returns are very good actually, right? So that's the beauty of SIP. Mostly what would happen is, in these kind of falls, you see for few months, and then you stop your SIP, right? And you start your SIP maybe much later, right? So if you stopped your SIP for 4-5 months during this time when it was below 3,000, your SIP returns obviously would be maybe closer to half of what you are seeing in this slide, 23%. So if you are a long-term investor, you do not have any short-term need from your investments. then you don't need to worry about your investments and keep on making those SIP investments. Be diversified, obviously, be diversified across funds, be diversified across equity and debt, right? But I don't think there's anything to worry about for long-term investors. For short-term investors, yes, if you need the money and you've invested in equity markets, you need to take out that money, then definitely it's not a very nice thing to do when you are exiting from equity markets at these levels. But for long-term investors, definitely, I think this is a good time. Frankly, when markets fall, I personally feel very good because I am able to enter at much lower levels. I do not have any need, at least in the next 5 years, of the money that I am investing in equity markets. So I certainly feel very good when markets fall. Yeah. So I think I've covered. Okay, there's one more question. Since rebalancing occurs only once a month, how can we capitalize on special situations such as budget or other markets? So Poonam, I think that's one of the, you can call it a drawback with quant strategies because we are rebalancing once a month. If something happens mid-month, then we are unable to capitalize on it. But having said that, see, in long-term investing, even 1 month is a very, very short period. If something has happened in budget or in any other thing, the maximum time that we haven't taken any decision is just 1 month. And if that decision or that change in the market is significant enough that that the impact of it would be felt in the next few quarters, definitely, then having missed out on 1 month of returns is not really meaningful for me, really, right? Because if that trend were to continue for much longer, only if that trend is to continue for just 1 or 2 months, then obviously I'll miss out. But that's okay because here I'm not trying to capitalize on 1 or 2 month trends. I'm here trying to capitalize or generate alpha over longer run for long term investors. So this is maybe a short, uh, a small problem, maybe you can call it, with quant investing, but then there are many advantages, like we are able to process our data much faster and make our decisions much more faster than discretionary investors during normal times. Yeah. So yeah, that brings to the end of the questions that we received. And now I'll take on, I think we have received quite a few questions on YouTube also. So I'll take these questions. So Shubham is asking, hey, when you get the chance, I would want to understand the prospects of Gulaq Gear 6 for the coming year. It has taken a significant hit and want to understand from you what's the way forward. So Shubham, there are two things I would see here because I have my investments also in Gulaq Gear 6. And the way I see it is, uh, one is what's the probability of making or generating alpha over 1 year period, right? And as I've mentioned to you, that probability is about, I think, 80 to 85%. So over next year also, what I would consider is we have about 80 to 85% chances of beating the market. That's what I see. And the second thing that I see is slightly over long run, let's say next 5 years or 10 years, what is to be expected. And again, I'll just go to either the back tests or the live returns that we have generated over past close to 4.5, 5 years now. So I'll take a cue from that, and uh, then I would uh, form my expectations. But having said that, both of those historical returns also and live returns have been phenomenally good. I think the overall CAGR expected, if you look at that, is about 35 to 40% over any longer period. My expectations is fairly low from Gulaq Gear 6. What I expect is markets from markets, I would expect 12 to 15%. If we are able to do more than 20% post my cost, I'll be very happy with our performance. Personally, for myself also, that is my expectations. But you can look at other expectations like back tested or live returns, right? Bharat is asking, why do you think markets are down? When do you think? Uh, when do you see them? So Bharat, I think I just want to go back to what I just said about SIP. I think the what we spend most of our time is on the questions like what is happening in the market, why is it down, when it can recover, and most of the news also, if you see, almost 80 to 90 or even 100% of the topics being discussed are around these lines only. And I think they have very little to zero impact on your longer term returns, frankly. What really impacts your longer term returns is the kind of discipline and patience, though that will actually impact your returns much more than any other thing. Now, when the markets would recover, frankly, I do not have any idea. I don't really care. What I know for with fairly good amount of certainty is 10 years down the line, markets will be almost 3x from where they are at. If markets keep giving about 12% CAGR, your money becomes 3 times in 10 years. So that is what my expectation is. That's how I invest my money. That's what I would recommend. That if you take a longer term view, you'll be much. It will be very easy for you to manage drawdowns like what we are currently seeing. Abhinash, uh, uh, the return since September is minus 16%. This gives away all the previous gain strategies not able to recover. Yes, Avinash. So that is, you're correct. Last 6 months have been really tough, and we have had more drawdowns than the market. But as I've showed you in the drawdowns, also in the earlier periods, also we have seen these kind of cases. We have been much faster. At least that's what history tells us. We have been much more faster to recover also. And from time to time, definitely we'll have periods where we underperform the market. That's what we have seen in the data. That's what we have seen in uh, with all the good or bad mutual funds also. That there is no fund which has beaten the market year after year for say 10 years. So that's not hard but impossible thing to do, and that is what is happening with us also. That for the last 6 months to 1 year, our performance hasn't been as great, but take a slightly longer term view, and I think you'll be rewarded for that. Again, Avinash, one of the thing is also I keep speaking to investors, and uh, one or two investors that I spoke to last 1 or 2 weeks, what they had done is 100% of their money was invested in Gulaq Gear 6. Now, this is something that we have never recommended. And in all our webinars and whenever we had a chance to talk to investors, what we recommend is never to have maybe 25 to 30% of your money, more than that, in one fund. So that's with Gulaq Gear 6 also. And they were really worried that they had invested 100% of their money. Obviously, in the initial time, having seen those good returns, that's when they got the confidence to invest 100% of their equity allocation to Gulaq Gear 6. And that's what I recommended also, that you should cut down. At least the new money that should go in should not go in Gulaq Gear 6 because they have 100% allocated. But if you are not 100% allocated, you have about all the equity allocation is between, let's say, 3, 4, 5 funds, then I think you don't have much to worry about. Yeah. Uh, Hashira is asking, can you please provide outlook on PMS returns in the last 5 months? So, last 5 months exactly, I don't remember, but yeah, last 1 year, uh, last calendar year, we delivered about 25% returns in our PMS long alpha, and we'll be happy to speak to you. You can just get in touch with our support team or go to gulaq.com. We have all the details about our PMS performance on gulaq.com. You can check it out and get in touch with us. Mohit Gupta, Vivek sir, thank you, Mohit, for your kind words. Our fund not performing well in last. What changes are you planning? Yeah. So, Mohit, you're asking that what changes we are making in our model so that we can start outperforming the markets. So the way overall we work is, it's not that we start making changes only when we underperform. So that's a constant process that we follow, that every few months we upgrade our models slightly, right? There was a big change in September, but otherwise every few months we keep on upgrading our models, dependent on, we have a research team who is always looking on ways to improve our models. So we keep getting new ideas, we keep getting new sets of data, and we keep trying out how we can make our models better every time. So it's not that now that we are underperforming and then we are thinking about upgrading or improving our models. That's a very constant process. Be it good times or bad times, we are always looking for ways to improve, and that is the same thing that we are doing currently. We are looking, based on our learning over last 6 months, 1 year, we're looking to improve our models, and that's what we are doing. Yeah. But having said that, this is totally part and parcel of active investing, this kind of underperformance. Why do we have separate quality factor? Is it not the case that you identify quality factor first and then we see which one of them have more? Yeah, Hashira, so that's not how it happens. Quality is a totally separate factor. It's not that first we identify the quality stocks which are very highly rated on quality and then we select. It's a mix of these factors, right? So that's not how sequentially, it does not work sequentially, but rather parallelly. We figure out broadly what is the factor weightage I want to have. So it could be some part given to quality, some part given to value, some part given to momentum, and then we figure out what are the top stocks based on the consolidated scoring from the factors that we have selected. So that's how we select our stocks. Sahil, what's the reason behind sticking to Kalyan Jewelers amidst a lot of negative news? So, Sahil, again, we do not take news into account when we are making our decisions. It's purely dependent on the factors that we have just spoken about. If these factors tell us that it's a good stock to be invested, because news could be positive, news could be negative, and we don't really have a view of how much a stock can be hit because of a positive and negative news. Now, one of the things that we are trying, Sahil, to do is to use AI to actually go through all of these news and social media chatter that is going on, to figure out what's the tone of the discussion or the tone of news, and we take that into account while making our decisions. So that's something that we are currently working on. Uh, but when we use these models in overall methodology, they did not produce any meaningful alpha over what we have currently. Now, the reason obviously could be, in some of the cases there was definitely clear cut alpha, and based on these news we were able to avoid the downturns. But then there have been other cases also when we saw positive news um, and those stock came down, or the other way around also, that we were getting negative news and still in spite of that uh, the stock kept on going up. So we see all of those kind of cases, and that's why looking at news is not a very good way to do your long-term investing. At least that's the view currently we have. Again, as I said earlier, that we keep on doing a lot of research as to how to improve our models, and this is also one of the area that we are actively looking at. And if we are able to figure out that this strategy does add something of value to our overall portfolio, we would add. But as of now, we haven't found anything meaningful in the news actually. बलबीर सिंह इज आस्किंग, विवेक सर नमस्कार, आपसे निवेदन है कि आप हर महीने की बजाय 2 महीने में एक बार रीबैलेंस करें जब मार्केट केवल डाउन में हो। आप हिंदी में भी बोलें ताकि सभी को समझ आए। या बलबीर, सो हमने पहले थोड़ा सा हिंदी में भी ट्राई किया है, और जब भी हम हिंदी में बोलते हैं तो हमें काफी कमेंट्स आते हैं कि आप इंग्लिश में ही बोलिए, हमें हिंदी कम समझ में आती है, राइट? बट आई एम हैप्पी टू आंसर योर क्वेश्चन इन हिंदी. बल्कि ये भी चीज हमने एक्चुअली ट्राई की हुई है। हमने 2 महीने नहीं, हमने ये देखा था कि हम 1 महीने की जगह अगर 3 महीने में क्वार्टरली अगर हम रीबैलेंस करते हैं तो कैसा होगा, क्योंकि मार्केट डाउन है, ये तो हमें कभी भी नहीं पता है कि कब मार्केट डाउन जाएगी या ऊपर जाएगी। बट हमने ये डेफिनेटली ट्राई किया हुआ है कि अगर हम 1 महीने की जगह 3 महीने में रीबैलेंस करेंगे तो उसका क्या इम्पैक्ट आएगा पोर्टफोलियो में। और उसका रिजल्ट ये था कि अगर हम 3 महीने में कर रहे थे तो ऑब्वियसली हमारा चर्न, ब्रोकरेज कॉस्ट, ये सब काफी कम हो जाता है। बट एक नेगेटिव चीज ये थी कि जो अल्फा अभी हम प्रोड्यूस कर पा रहे हैं वो भी काफी कम हो जाता है। और दूसरी चीज ये भी आती है, आप जैसे बोल रहे हैं कि 2 महीने में किया कीजिए, अभी कुछ टाइम पहले ऐसे भी कमेंट्स आए थे कि हम 1 महीना भी क्यों रुकते हैं, अगर न्यूज आ गई तो हम उसी टाइम क्यों नहीं कुछ एक्शन लेते। तो अगेन जो हमारा एक्सपीरियंस रहा है कि 1 महीना बहुत ही एप्ट है, क्योंकि उसमें हम अल्फा भी जनरेट कर पाते हैं और अपना कॉस्ट भी एक रीजनेबली लो रख पाते हैं। जब भी हम अपनी स्ट्रैटेजीज बनाते हैं तो ये सारी चीजें हम कंसिडर करते हैं कि हम कितना अल्फा जनरेट कर रहे हैं और कितना आप लोगों को एज इन्वेस्टर हम सबको कितना ट्रांजैक्शन कॉस्ट देना पड़ रहा है, कितना स्लिपेजेस आ रहा है, और उसी के बाद फिर हम अपना स्ट्रैटेजी फाइनल करके रोल आउट करते हैं। तो हमने ये सारी चीजें कंसिडर की हुई हैं जो आपने सजेस्ट किया, बट जो हमारा करंट मॉडल है वही बेस्ट वर्क करता है। Let me see if I have okay, I think I've covered all the questions. So thank you everyone. One sec, I'll just go through once again. Yeah, so we have covered all the questions. Thanks everyone for attending today's webinar. I know it's a tough time as an investor. Overall market sentiments are down. Uh, our portfolio is also slightly underperforming, but as I've told you, I think the biggest factor in your long-term returns is really not the not the fund that you have selected, but it's much more about patience and discipline and investing through SIPs. So yeah, that's what I have to say. Thanks a lot, everyone. Thank you.